Welcome back. Now that you have some understanding of a stock exchange, let's take few minutes to understand how a typical transaction gets completed at the exchange. Essentially, secondary market transactions have three phases. The first phase is trading. Trading involves actual buying and selling of securities. Exchanges use electronic order matching systems where they essentially match buy and sell orders from different people so that the trade may be executed. So for example, if these are the various buy orders on a security and these are the various sell orders, so the matching system tries to see if there is a match between a buy and sell order at a particular price, and if so, fill both the orders. By doing so, the exchange facilitates efficient, speedy, and anonymous execution. All investors depend on brokerages to execute their trading orders. So, brokerages essentially collect orders from various investors and pass it on to exchange so that when you start trading, brokerage is the intermediary you will be directly interacting with, and the broker will interact with the exchange on your behalf. The next phase in the life of a secondary market transaction is clearing. So once two orders match and a trade is executed, the trade has to go through something known as the clearing process. Clearing is the process of identifying which securities and in what quantity is owed to a specific buyer and what payment is owed to the seller. So for example, if for a trade, investor A is the buyer who buys 100 shares of a company X at $10 each from a seller B, the clearinghouse would do the math and conclude that buyer A is owed 100 shares of company X and seller B is owed $1,000. Now if the buyer or the seller has performed multiple transactions, then the clearinghouse will identify all securities owed to them and the net payment owed to or owed by them. Clearinghouses or clearing corporations are independent entities who manage this entire process. Once the clearing process is complete, the next process is known as the settlement process. So after the clearing process is complete, it becomes clear what security in what amount is owed to an investor and what funds are owed to or by them. The next step now is to fulfill these obligations, which is done by following the settlement process. So settlement is essentially the process of fulfilling the respective obligations to buyers and sellers of security. By the way of this process, the buyer receives the security owed to him and the seller receives the payment owed to him. Once buyer of the security receives the security and the seller of the security receives the payment, we say that the transaction has been settled. Now different intermediaries play different roles depending on where they are involved in the transaction. Let's look at them one by one. Starting with the trading members. Investors can trade only through members of a stock exchange. Trading members are also called stockbrokers and their affiliates are called subbrokers. Trading members are admitted to an exchange only if they fulfill certain minimum requirements for capital, qualification, net worth, and other criteria. Exchange members can either be trading members or clearing members or both. Exchanges monitor these members for their positions, capital, and compliance. Their obligation towards clients is also clearly laid out to them. These trading members are the intermediary that a typical investor deals with directly. The next important intermediary are the clearinghouses. Clearinghouses facilitate the clearing process we described earlier. Now clearinghouses are set up as independent entities who act as counterparties for all trades executed on exchange. Hence, all buyers pay funds to the clearinghouse and all sellers deliver the securities to them. Clearing members are members of clearinghouse who facilitate these transactions by directly interacting with buyers and sellers. The clearinghouse may be wholly owned subsidiaries of stock exchanges, or they may be a completely independent financial institution. The purpose of clearinghouse is to reduce the settlement risk by using certain risk management mechanisms. Clearinghouses often implement netting mechanism and a system of requiring margin deposits to mitigate settlement risk. Another important intermediary are the depositories and depository participants. Now, depository is essentially an institution that holds and facilitates exchange of securities. Centralized depositories enable brokers to deposit securities so that book entry and record keeping services can be performed. In order for a security to trade in the secondary markets, the security should be held in electronic or dematerialized form. The issuer who issues the securities admits them to the depositories, where they are held as electronic entries against investor names. In order to facilitate this process of keeping this list updated, depositories appoint depository participants who act as intermediaries between the depository and the investor. Every investor holds a demat account with a depository participant. The settlement of securities is done through this demat account with the depository participant. The depository participant in turn notifies the depositories about change of ownership. The payments for respective trades are settled through pre-identified clearing banks. Another important intermediary we like to mention are custodians. Custodians are institutional intermediaries authorized to hold funds and securities on behalf of large institutional investors like banks, insurance companies, mutual funds, and foreign institutional investors. Custodians essentially settle secondary market trades and may also act as clearing members and clearing banks for the institution in order to manage settlement of both securities and funds.